Oi, sejam bem-vindos. Meu nome é Filipe Carneiro, eu sou sócio da Itajubá Investimentos e sou um dos responsáveis pela área de relação com investidores aqui na empresa. É um prazer ter vocês aqui no nosso Golden Talks, espero que vocês gostem. Para discutir hoje com a gente o tema sobre o mercado de crédito na pós-pandemia, a gente tem aqui dois dos principais executivos da Oaktree responsáveis pelo fundo Global Credit, Wayne e David. É um prazer receber vocês, convidados do Congresso Brasileiro de Previdência Privada, nesse bate-papo. Eu espero que vocês gostem e vale lembrar que ao final a gente vai ter um prêmio sorteado para aqueles que acompanharem a gente nessa jornada. Hi, David. Hi, Wayne. First of all, I want to thank you both for joining us today and say it's a huge pleasure to have you both here. And for us to start here, let me ask you guys for you both to do a brief introduction about yourselves and about Oaktree. Do you mind?
Sure. So I'll go first. So I'm David Rosenberg. I'm co-portfolio manager of the U.S. and global high yield strategies here at Oaktree. Oaktree started in 1995. It's an alternative asset management firm with roughly 140 billion under management, with its roots very much in debt. Started with high yield bonds and distressed debt, and has now grown to have multiple strategies, including private equity, convertible bonds, and real estate, and many others. So, something that we're quite proud of our lineage. But and I'd say a lot of it comes from really proving ourselves out via credit selection. So we view ourselves as the firm that will do well in times like we recently have seen with COVID. When things are difficult, that's when Oaktree tends to shine. I've been at Oaktree 16 years. So I came to Oaktree straight out of business school as a junior analyst in the high yield team, and have kind of ascended through the ranks to end up co-managing the group today. So that's my background.
Thanks, David, and thank you, Filipe, and it's great to be here. I'm Wayne Dahl. I joined Oaktree about 4 years ago, focusing on really investment risk and how to add a component of kind of a quantitative overlay to a lot of the qualitative fundamental work that David highlighted. Particularly in the areas of asset allocation and portfolio construction. Prior to Oaktree, I've spent a little over 20 years at a number of different hedge funds, primarily in credit strategies, everything from convertible arbitrage to similar kind of fixed income fundamental strategies, always with kind of an angle towards more of the quantitative side. So excited to be part of Oaktree and here with you today.
Great. Thanks, guys. So I think we have enough experience to help us on today's topic. So to start, and honestly, prior for us to jump a little bit in the future, let me take advantage of that experience and ask you guys to tell a little bit about the past. I think it's always helpful to understand the past, to understand the future. And for that, probably you guys faced a lot of crises and different periods in the market during the whole time you guys have been here. So let me ask you guys, can you give us a little, at least a brief view on your thoughts about the main differences between the prior crisis and the one that we are facing now? Let's call it a crisis or period, whatever you want to call it.
Sure. So I'll jump in first. I'd say there's a few differences here. The big difference, obviously, is the driver. This crisis was driven by a pandemic. Typically, when you think about previous crises, they're driven by investment behavior and people kind of going too far on the risk spectrum until things tend to kind of hit their peak and blow up and cause a recycle of things. I think the other big difference here is it happened very quickly. So, one of the things we've seen is a kind of a hallmark of how these things play out, going back to the global credit crisis and before, is that the central banks have become more and more aggressive about what they're doing to try and keep us out of trouble. And I think, this crisis in particular, they were particularly aggressive. And so the market was down, but only for a month or so before things started coming right back up. And that to me is a very, very important difference.
Yeah, I would.
No, go ahead, Wayne. Sorry.
I'm sorry, Filipe. I was just going to say I definitely agree with David. I think the speed at which and the size of the reaction by central banks is one of the key differences. But one of the similarities, and I think back to one of the early crises that I experienced was in 1998 with the Russian default and essentially the seizure of long-term capital. And at that point, it was a reminder of how quickly liquidity can change. And, so David's right that it wasn't kind of financial market behavior that got us into this crisis, but that liquidity challenge and the Fed's willingness to step in and other central banks quickly to ease that liquidity and allow markets to function has been a similar factor in all these crises.
Got it. And now jumping to I think what everyone wants to hear. So looking for that background you gave us and that differences, what do you think we can expect in the future? So how markets are going to react? What's going to happen? We know that we had a spike in the market in the beginning of the year as a consequence, but a lot had changed since then. And I think the biggest question is what's going to happen. What are your thoughts? And let me ask you to add on that component the U.S. election. We just had it, the results, and probably it will cause another impact there, right?
Yeah. So when you think about how things are going to play out going forward, I think there's a few things you got to realize nowadays. The market is almost become reliant on central bank intervention. And so, the underlying problem that causes is that, you can see, and we saw this distinctly in March, which is you can separate the market into those who knew how to do credit and those who did not. Because the ones who did not know how to do credit and were really kind of relying on the central banks to always keep them out of trouble were panicking and selling. And those who knew how to manage through credit and underwrote what they owned and believed that there was cushion for things to go wrong, were holding on to what they owned and buying from those who were panicking and selling. And so I think that right now you're in a market clearly where for future problems, you already see it in the dialogue that, what's the, in the U.S., what's the Fed going to do? And so the challenge that causes for the Fed is if the Fed is going to shock us out of a problem, which is kind of part of what they try to do, then it's not very shocking if the market's expecting it and pricing it in, which means they're going to have to, every time something goes wrong, they're going to have to do something bigger and bolder. And we saw that this go around. But, you do have to be cautious about how effective they can continue to be if the market continues to expect them to kind of be a quick savior. I think when you look at the election, it's interesting right now because we've certainly gone through a lot of volatility in the U.S. as we try to figure out how this is going. And, by now I was expecting to be able to tell everybody that everything was resolved and we can move forward. And while everyone expects the resolution to be done, it's certainly not finalized just yet. And so I do think that, as we look to deploy capital, you have to kind of think about different policies and which sectors you need to be careful about. Healthcare, energy, there's certain sectors where policies are clearly going to shift. And so we've been kind of actively looking at our exposure in that regard.
I would just add and agree with everything David said, and certainly the one factor is that with the speed of the reaction to central banks, there is kind of a growing expectation that these sell-offs will be short and shallow, and we won't really feel a big impact. And maybe that means that credit work that David spoke about isn't as important. But the reality is that it'll potentially become more important because, again, the Fed's job is not to halt, not to solve solvency issues with companies. They're trying to solve market liquidity. So, those companies that, lever themselves to, bailouts and investors that kind of lever themselves to that kind of action could be in for a surprise when the market really does start to separate the good from the bad in those situations.
And I would just jump in because I do think it's a really important point Wayne makes, which is the Fed did a great job. They, if you go back to the end of February, March, when all of this began, the market went through a few cycles of emotion, if you will. There was a panic, but nobody wanted to sell because everybody said, well, you know, the market was down 1,000 points on the Dow Jones. One day it was up 1,000 points the next day. And so everybody just wanted to kind of hold their breath and make it through, and nobody wanted to sell. So there's very little trading. You got towards the end of the month and people needed liquidity because they're worried about fund redemptions. And as they need cash, people started selling, and then you had real transactions moving. And then the Fed stepped in and changed everything. And so you had all these companies that were desperate for liquidity, you know, facing, you know, the COVID pandemic and the fact that to solve the COVID pandemic, you're shutting down the economy. And there are a lot of companies in lodging, leisure, travel that were facing the prospect of no revenue and would have had to restructure. And the Fed opened up the market to provide them with liquidity. And I think liquidity is what most people focus on, which is, do you have enough cash that you can make it? Generally, people would raise about 12 to 18 months of liquidity so that if there was a second wave and if things got worse, they had enough cash to make it through. But what people didn't talk about enough, in my view, is that these were not grants we were providing companies. These are loans. They do have to repay them. And if you're borrowing money to fund a cash burn, the only thing you can guarantee is that you're going to come out of this with more leverage, because you're not growing your business. You're taking this money just to fund a cash burn. And so I do think that you're going to start to see now defaults coming through. And while the central banks stepped in, you know, I think it's important to think about what the central banks did and what the central banks did not do. The central banks did step in to say, we need to keep the market moving. We need to make sure that people are providing liquidity when necessary. What they did not do is step into smaller, over-levered LBO companies that needed to grow into their balance sheet to survive and bail them out. So there is still a cohort of the market that, you know, is dealing with the fact that the economy is not going to grow as quickly as they had hoped, and they're going to have to restructure. And so I think, you know, we've been through a period of, you know, 5 to 7 years of very low defaults, and now we're going to be entering a period where defaults are going to be higher, and you're going to have to be able to avoid the problems.
Got it. Yeah. I think you guys touched a lot of points here that are important and probably are going to raise another question. One of these points, these topics, for sure, is the central bank's intervention, and I'm going to save that for later. I will definitely ask you guys to go deeper on that, because I think there's a lot of noise and discussions around that. But prior for us to go to that topic, let me ask you, because here from what I heard, so we see that there is a lot of challenge in the market for sure, but in the other hand, it seems there are a lot of opportunities, and I know you guys as a firm are looking for different sectors, different instruments in the credit space, and are chasing for those opportunities. So if you guys could comment and tell us a little bit about where you guys see the opportunities in the market, what are the sectors you guys are looking, what are the instruments you guys are thinking about, and in the other hand, what you guys fear the most? Where are you guys staying out for sure because you don't know what's going to happen? This particular instrument, it's a black box. I don't. So if you guys could tell us a little bit, I think it would be very helpful for the audience.
Sure. So I think, you know, the first part on the opportunity side, what gets most exciting to me, you know, when you're in a shop that you know, has very good credit expertise, what you like to do is to be the contrarian, to look at the sectors that everybody's afraid of and find a low risk way to participate in a risky sector. And so today, I think that is very much in the COVID related sectors. So as I mentioned before, travel, lodging, leisure, gaming, you know, any sector where you need people to congregate in a large group in order for the company to make money. And these companies are in need of liquidity. And, you know, even with the news of the vaccine that we've seen recently, there is still a lot of questions surrounding, you know, when that vaccine is going to be delivered in a size and scale to really impact the greater population. And so there's going to be a meaningful lag from today to then. And in the meantime, companies need liquidity. And so we can lend to these companies effectively and be comfortable that if COVID is resolved, as people are hoping, these sectors will perform very well. And if the vaccine turns out not to be what everyone hoped, we're still going to come out without losing any money because we've secured ourselves with very valuable collateral. And so that's been the most attractive, I think, part of the market today. is to go into the sectors that people don't want to touch and structure deals that provide good downside protection for you. On the things that we're unexcited about or worried about, I think right now, you mentioned the election before, so I think there are sectors in the crosshairs of the policy change. I think policy change is a difficult thing to analyze, what people are going to do, and so there's businesses such as student lending, private prisons. Those are businesses we've exited out of, some time ago because of our concern that coming into this election and coming out of it, it's uncertain how this business is going to go. And so I think we try to stay away from binary businesses like that because we're buying debt. And so when you buy debt, a binary story, you're usually not getting compensated to take that kind of risk. And so been avoiding those problems.
Yeah, I would also add in general, and this is, kind of adding on to David's point, is that one of the things that we certainly did immediately coming out of the crisis was search for quality assets that were trading at a discounted price. And, this is one of the advantages of having, a team of fundamental research analysts across the board that are digging into the fundamentals to find those securities that, the expression in English would be, securities where you've had the baby thrown out with the bathwater. So, for example, in the real estate sector, certainly one that's impacted heavily by COVID with, gaming shutdowns, hotels shutdowns, offices closed, other challenges there. But there are certainly pockets of value that you can find. And what ends up happening is the investors that were, maybe investing in those because they thought they had attractive yields and they had attractive spreads relative to other markets, didn't really understand or appreciate the fundamentals. They were the ones first to exit. That's where we can come in and pick up the pieces of the companies and the securities that still have value. Same thing would apply to areas like emerging markets. I mean, you're certainly familiar in Brazil with people, investors around the globe that come into these markets again because they're attracted to their higher yields. They don't really understand the mechanics of the markets or the securities and will tend to exit very quickly. Again, that's areas where we want to come in and apply our fundamental approach to sort through and find the quality companies. And we're continuing to do that today in some of the most dislocated markets. Again, real estate being an easy one, some other parts of structured credit and other parts of, various industries, as David mentioned. And, that fits very well with Oaktree. With one of our investment philosophies is the benefit of specialized expertise, and we're utilizing that expertise at the most difficult times in the market.
Got it. So we can see that there is a lot of opportunities and I guess ways of making money on that crisis, right?
I think volatility always provides opportunity. I was just going to say volatility always provides opportunity. I think that the key is going into the areas that people are afraid to go into. And I think, as Wayne mentioned, when we have a multi-strategy product, there's always somewhere to go. But in times like today, there's a lot of those opportunities.
Yeah, flexibility seems keen here, right? So, and you mentioned a little about the companies you're looking and seeing, and it sounded to me that here you're looking for companies, but it's a matter of time for them to get back on track and to recover, right? To go back to their normal prices. And on that sense, how do you think the vaccine is going to impact? So if tomorrow we have a vaccine, and not only have a vaccine, but have the capability of providing that for a large number of people, do you think everything is going to change, or will you still need time to see the recover for the companies to get back on the way on the places they were before the crisis? How do you see that?
Well, it's a combination of things, right? I do think if you have a vaccine, a lot of things will return to normal. I think there's a lot of pent-up demand of people wanting to get out of their house, people wanting to travel, people wanting to go to restaurants and spend money. And we have a consumer-driven economy, and if the consumers are spending money, that's positive for the economy. But I think that you have to take into account a few things. You have some behavior that may never change, which is, you think about business travel. I think business travel will come back, but it may never come back to the same full 100% of where it was, because people have learned that Zoom conversations like the one we're having right now actually work out okay. And it's a very efficient way to communicate with people, especially internationally, and I think that will continue. So I think there's some behavior that will have permanently changed. I also think when you think of the vaccine, you do really need to think about the logistics of it and the reality that, I think there was a survey done not too long ago, I forget which periodical did it, but saying I think maybe 60% of people said they'd be willing to take the vaccine. So there's a fear of, the quicker you get something to market, the less time you have to test it and make sure it's safe. That's going to have an impact. I think you also have to think about, this is a global pandemic. So, saw some numbers not too long ago with the Pfizer vaccine, which is the one everyone's talking about, and how they can, presumably generate about a 1.3 billion doses in a year. But it's a 2-dose vaccine, so that's 650 million people that they can treat. And, you got to start with first responders in high-risk categories, and there's not quite enough to necessarily really make it very far in that regard. And you have a vaccine that needs to be frozen in order to transport, and so there's going to be issues there as well. So I think that, there's getting the vaccine, proving it works, and then there's making it and getting it to everybody, and all of that could take some time. And if you have a company that is in a sector where people are not going out, if you have I always like to kind of point out a small, medium-sized restaurant chain that is waiting for people to be comfortable going out to eat again. If you have to wait presumably another year or longer for this vaccine, that may be too long, and you may not have enough money to make it that far. And so I think that the vaccine is a very strong positive, but I think you still have to be very careful about where you kind of deploy your capital, considering the fact that it's not an overnight event. And in the interim, from today to when we do get the vaccine going, the cases are starting to go back up. We're coming into winter, which is supposed to be a bad period for the virus as far as its propensity to spread, and so you run the risk of the quarantining initiatives actually getting more severe before they dial back.
And just to add to that, David's absolutely right. I think one of the key factors is timing. What we do know is that a vaccine, even with, again, the announcement of Pfizer, is not going to be broadly available right away. There's still significant time before a large part of the country or the kind of global economy will have access to that. So what happens in the meantime? We like to kind of paint success by the market's ability, particularly the equity market's ability, to look through some of these challenges. But again, the reality is that there's a lot of dispersion in the market. There are people who've benefited. There are companies that have benefited. There are people and there are companies who have, are really quite down from that prior period, and any kind of further extension to their inability to get back to work or those companies to function normally again is going to be troublesome. We are happy with the pace of the changes in unemployment, but at the same time, there are the participation rates down. There are a lot of people that were in the labor force that are no longer in the labor force. Those are challenges that we're going to have to deal with and we're going to have to face. So again, a big part of it is timing, and I think the road for some will be quite bumpy between now and that success. And that's, again, to kind of come back to what David said in the beginning, that's the importance of continuing to focus on fundamentals and try and separate out, using active management to separate out those companies that have benefited from the broad market, but maybe don't quite have the right the right fundamentals, cash flows, staying power to reach beyond where they need to go. So, again, we have to be just a little bit careful with painting everything as a success when equity markets go higher.
And Wayne brings up a good point, which is unemployment. And unemployment is really important. We do have a consumer-driven economy, and our unemployment rate is higher than the global credit crisis right now. And in the U.S., we've made it through that because basically the stimulus efforts have given people more money on unemployment than they were making, in their job. And that's clearly not a sustainable solution. But the other thing, to your point about, kind of the future and how things are going to look post this virus, a lot of companies, we sit down and we speak with the CEOs of every company we're invested in regularly. And a lot of them have come back to us to say that when all of the dust settles and we're on the other end of this COVID pandemic, they're not planning to bring back all the employees they furloughed. They've managed to work with less. They've figured out how to run leaner, and they're going to continue to do that. And that's a natural thing. We see this coming. I've seen this coming out of previous cycles as well. As companies, when you're in trouble and you need to tighten your belt and cut costs, you do that. And when things come back, you realize that you've learned how to run leaner, and that increases your profitability. And so that's good for those companies, but it's not good for solving an unemployment problem. And you mentioned the election before, and so coming out of this election, now we've got the prospect of having a Democratic president and without control of the House and the Senate, which means that getting through something like a very large stimulus plan isn't a slam dunk. There's going to be a lot of back and forth in that regard, and so that's something you have to be cautious about.
Got it. Yeah, makes total sense. And following here, so as per all that you said, looking for companies itself, what differentiates a winner or from a loser? Looking for a company perspective, it's access to capital, capabilities of how the company is capable of restructuring itself. What do you think are the main things here that will differentiate and will make a company comes out of a crisis like that or not, or to fail during that period that they will need to?
Yeah, so the key is cushion for error. Yeah, the key is cushion for error. We have a process, one of our, the first tenet of our philosophy at Oaktree is if you avoid the losers, the winners take care of themselves. And so we've always believed that the key to success in a fixed income product is avoiding the losers. Everything else works itself out. Bonds, and I live and breathe bonds, but I think this applies to all of fixed income, which is, fixed income, you get your coupon, and when things mature, they pay you back as long as they don't default. And so the key is avoiding defaults. And to do that, we have a proprietary process here at Oaktree. We call it our credit scoring matrix. But basically, in the end of the day, you're going through companies to say which companies have cushion for things to go wrong. And this is what we did. I tell clients all the time, when COVID hit, it wasn't that we expected a pandemic. Nobody expected the pandemic. But what we did do, which bared a lot of fruit, was make sure that we were only investing in companies that had cushion for error, cushion for the unexpected. And if you have a company that's levered itself to perfection and is not generating a lot of free cash flow and is in desperate need of the economy to continue to grow to solve this problem and grow into its balance sheet, you avoid those because unexpected things happen. And so that to me is really the key. And so how do you do that? We go through a lot of analysis, kind of looking at what industry are you in, where is the company's position in that industry, how is it capitalized. And I think a lot of it comes to kind of how much cushion do they have as far as what free cash flow do they generate, how variable is their cost structure, what have they done to stabilize their business when it comes to hedging in raw materials or locking in contracts for minimum volume. And we spend a lot of that. We look at what type of flexibility does this company have. They have assets they can sell, or to your point, do they have access to the markets via maybe raising equity or more debt, and how is it structured? And so we go through this analysis with every name. And I think the real key to this process is that we vet the credit first and we look at the relative value second. And I really do think that's one of the main things that sets Oaktree apart, which is the coupon is irrelevant. I've been told many times by Howard Marks that the promised return is nothing more than a promise. If the company goes bankrupt, it's not going to pay anyways. So the coupon is not relevant for a bad credit. So we go through a process of vetting the credit with no discussion about yield or spread or price. Just, is this a good credit? And when we're done, then we take all the good credits and we look at the relative value and say, amongst this cohort of acceptable credits, where can we get the best relative value? Because again, we do want to maximize the returns for our clients, but we want to do it with risk under control. And I think that's how you separate the companies that can make it through these times and the ones that cannot.
And just to add there, I mean, David touched on a critical point, which is margin of safety, and that's certainly something we want. And he spoke from the standpoint of individual companies and making sure, but there are other beyond just companies, there are other investments that we make in securitized assets where you're investing in cash flows that are tied to a pool of assets, and in there you may not be exposed to the first losses. So what is your margin of safety? How much loss can you withstand? What if we run those through stress scenarios? What if, yes, the value may decline in those cash flows for those hospitality assets, but if they come back in 2 years, 3 years, if the value moves, do we still have enough margin of safety to make that investment? So, that is something that is critical. And again, not only companies which will survive, but also different types of investments. Again, making sure that we are protected, as David said, that risk control aspect, which is again our number one investment philosophy.
Yeah, makes total sense. Move forward with cautious, right? Like you guys always say.
Move forward, but with caution. That's right.
Yeah, it's the mantra, and it's working, right? Have been working since the beginning and keeps working.
Well, Filipe,
great.
I mean, it's worth noting that yes, that was the mantra coming, over the past few years. But remember, I mean, if you followed Howard's memos, there was a period during these last several months where he said it is not time for caution; it's time to be aggressive. So, it depends on the kind of the background we're in, but we always kind of have that eye.
Great. So good, guys. I think in terms of opportunity, you guys covered a lot. So, but let me get back to a point that you guys raised regards the intervention of central banks in the economy. And I think this is a subject that is calling a lot of people attention, time, and discussions. So how far do you guys think those central banks can go, and what can be the impacts? Because a lot of people is fearing what they can do and how this can impact the economy and the monetary policies, as we know. So what are your thoughts on that? Can you guys let us know what you guys are discussing and thinking about it?
Sure. So we think about this a lot because you see how powerful it is. When the central banks get involved and start pushing people down the risk curve, you get investment grade buyers now trying to buy high yield in order to get the yield that they need. And so it's a very powerful tool. I alluded to this earlier, but I do believe that every time the central bank acts, it causes the market to kind of price in the expectation the central bank is going to bail them out, which means they have to do even more the next time in order to kind of surprise people and kind of get things kind of running again. And so I do think there is a limit to what central banks can do to kind of artificially prop up an economy. I think economic cycles are still here to stay. I don't believe we've seen the end of the economic cycle. I also do think that, in the short run, there's going to be a smaller window to act because the central bank has made it clear that they're not going to sit on their hands. They've seen how important it is to act quickly and act early. And so I do think, again, it goes back to making sure that you know what you own before the volatility hits so that you're able to act. As Wayne said, we move forward with caution, and then when the market dislocates, you have to be able to very quickly pivot to saying, now's the time to dial up the risk because you're getting compensated to do so. And that opportunity may not last for a very long period of time.
Yeah, in addition to that, I think there's a couple of things to think about with central banks, and this is certainly true with the developed markets, the ECB, the BOJ, the US and others, and even in China to some degree, is that in theory there's no limit to what they can do. I mean, you saw the US Fed take the balance sheet from 4 trillion to 7 trillion in a very short period of time. There's no reason they couldn't go from 7 to 10 to 15. But as David said, what has been clear over the last several cycles is that there's been a diminishing return to that central bank action. They have to get bigger. And so it kind of begs the question of when will they kind of hit the limit? And I don't think there's an easy answer for that. there's an expression sometimes people will say, it works till it doesn't. And, that's going to be one of those challenging things to watch with central banks is at some point that with those diminishing returns to their value add, that action and that impact will slow and eventually stop. And that could be painful for people who are really, invested against that kind of endless mindset. So I'm not sure that's today, and I don't think either of us are going to try and predict when that is. And we certainly know that they'll continue to take action, but it's definitely something that is part of the conversation at all times.
Yeah, I do think, look, it's very important to be aware of the Fed. The Fed drives short-term technicals and in some cases fundamentals as well. I think it's irresponsible to outsource your investment decision to the Fed as far as saying, I don't have to worry about credit risk because the Fed will just step in to bail me out of my problems. And so we would never do that. But I think that you have to, as Wayne said, I think you have to do both. You have to do your own work and underwrite your own investments, and at the same time be aware of where the Fed is in its kind of spectrum of what it can do, so that you think about valuations in that regard.
Got it. No, makes sense, and it's always good to hear your thoughts. That's why I ask it, guys. I think we're getting to the final line here. Any last remarks or anything that we didn't cover that you guys think it makes sense for us to discuss a little? I'm really open here to your thoughts.
I'll jump in just with something because I think it's interesting is that, recency has a big impact on people's view of relative value. And, one of the things that I always like to point out when I think of valuation in high yield, I like to look at spreads, the compensation you're getting to bear risk in high yield. But I think it applies to fixed income in general right now, which is we just came out of a period of excessive value. The spreads in high yield went, to 1,000 basis points. That's quite rare. And now they've probably been cut roughly in half for the market, more like 500 basis points. But I would say that there's still good value. I think there's still room for compression. If you look over history, spreads tend to hover 300 to 500 basis points, so we're still at the wide end of that normal range. And so I think there's still opportunities. And I would say, in particular, as I know we're talking about our global credit product here, when you have the opportunity to look around at a bunch of different asset categories, I think there's still interesting things going on. I just think you have to be a lot more selective now. When the market dislocates, there's all sorts of things you can buy, and as long as you don't buy things that are going to blow up, when the market rebounds, you're going to do quite well. As the market starts to rebound, I think you have to be more selective, but I don't think the story's over.
Yeah, I would completely. Yeah, I would definitely agree with David and add on to that is, look, number one, we were reminded this year that volatility does exist. I can't remember the exact numbers, but for the previous kind of 2 to 3 years, we only had a half a dozen days where the equity markets, say, moved plus or minus 2%. We've far exceeded that this year, even in just the last few weeks and months, excluding March. So that's kind of lesson number one, is that there is volatility and it can come, and you have to be prepared for that. Number two, we're probably in a period of low interest rates and lower yields for a long period of time. We talked about the actions of the Fed and the ECB and the BOJ, and you see it in these other parts of the world, that it's very difficult to let interest rates get a lot higher when you've increased your debt load by that much. Just as David would tell you, for a company that increases their debt too much, they don't want their cost of financing that debt to rise by 200 basis points. Our sovereigns are probably in a similar situation where it's unlikely any government wants their rates to rise by 200 basis points and have to finance that debt load at those levels. So, lower yields are probably going to be here for a long time, and we have to adjust to that and kind of understand how we think about that in our investing context and what constitutes relative value in that kind of globally lower yield environment. And I think you in Brazil, Filipe, you would appreciate this as much as anyone, where interest rates are down at levels that 5 years ago probably nobody would have anticipated would have been possible. So, you're adjusting, we're adjusting, everyone's kind of figuring this out. But at the end, as David said, there's always going to be pockets of dislocation. There's always going to be places to find value. And by focusing on fundamentals, we intend to dig those out of wherever they happen to be in the world.
Great. Well, I guess with that, we finish our conversation today. David, Wayne, it was really a pleasure. Thanks for the time. It's always good to have you both. Next time you come to Brazil, Wayne, bring David with you.
That would be fun. I look forward to that.
We will.
Just to visit us. We can definitely have some barbecue and some caipirinhas.
I'm gonna hold you to that. I'm gonna hold you to that promise.
Bom, com isso a gente chega ao final dessa conversa com David e Wayne da Oaktree. Espero que tenham gostado e que sigam acompanhando a gente ao longo de todo o congresso através dos novos vídeos que a gente vai postando aqui. Só para lembrar, assim que a gente encerrar aqui, nós teremos o sorteio de mais um Kindle. Então, boa sorte para todos vocês que estão participando e até a próxima. Obrigado.